Good morning and welcome to this GRM market update after another very eventful weekend and a very dramatic opening for the market overnight. We will go for 20 minutes. I hope we can stick to that. My name is Arne Lohmann Rasmussen. I'm head of research here at GRM. I'll say a bit about the latest development, but with me I have from our trading head of energy and options, Udayan, and head of oil trading, Marius. He is with us from Singapore. Udayan is in Copenhagen. I'm also in Copenhagen. And then we have from our sourcing team, our sister company, Unicore Fuel, Sean Burgin from Dubai. But without further ado, please remember you can ask questions during the webinar. Use the Q&A box on the top, and then a panel will show, and you can put your questions there. You can also put them anonymously if you don't want to have your name on it, and then we'll take the questions, those we have time for, after the presentation. And this is also being recorded. I'll just share my screen. Here we go. What you see here is the Brent first month's price, and do remember we were around $70 before last weekend. We moved up quite slowly the first couple of days. We moved to 80, but nothing dramatic, and then became more dramatic on Friday. We moved above 90, and then over the weekend it seems like things escalated. People realized that this was actually going to take longer. I've used the picture. This is like a snowball rolling in the desert, even though you can ask if that makes sense. A snowball rolling down a hill. It moves faster and faster, and it becomes bigger and bigger. And that exactly is what is happening now. Overnight, we briefly traded just below 120. Then came out Financial Times with a story, which is not a major surprise. I would say that the G7 is considering doing a coordinated release of strategic research. We'll come back to that. When I did this one, we were trading 106.7. I think we're trading somewhat lower now. So we have seen a bit of profit taking moving lower, maybe on the story about the release of the strategic inventories. If we just to take a brief look at the latest development, why are we seeing this escalation? Why did we see markets moving much higher overnight when it opened in Singapore overnight? We saw the bombing from Israel of oil tanks in Tehran. We have seen drones towards refineries on an oil field in Saudi Arabia. A clear escalation where energy infrastructure is now directly involved also in Tehran. As far as I understand, there's been no attack on Karg Island, which is the big export hub for Iranian oil. That is, of course, next focus point. Then there's an increasing focus on this, could have more long-term effects. More and more Gulf countries are reportedly being forced to shut down production. Simply, they are running out of storage capacity, both onshore and offshore. Some analysts talk about that we could be talking about 4 million barrels of production being shut in this week. Especially Iraq has been pretty hard hit, but also Kuwait. Then we have seen a new successor in Iran. The son of the late Ayatollah has been appointed. He is seen as a hardliner, and importantly, he has control over the Revolutionary Guard. And if someone believed, and if Trump believed that he could have a say in this, he was proven wrong. He is certainly not an Ayatollah that Trump would have elected. Then there's more and more news stories. Over the weekend, the U.S. ordered non-essential staff to leave the embassy in Saudi Arabia, for example. Of course, underlines this spreading of the risk to the Gulf states are just accelerating by the day. They are not safe. They're not sure that they can shoot down all drones and missiles, and we have seen it's not been able to do that. There are talks about could they run out of, for example, interceptors and missiles that could do that. There's also little news on the U.S. military convoy and insurance scheme that was put forward last week. I think there is a general feeling that a lot of people in the market, it's my feeling, is kind of losing confidence in the U.S. administration. Did they actually have a plan when they attacked Iran? Why was there no plan for a reopening of the Hormuz in place from day one, and so on? It adds to this uncertainty. It adds to the volatility in the market. It adds to higher prices. Udayan and Marius will talk about the impact on the product market and the bunker fuel, the fuel oil market. Remember there we have seen a much larger impact. It is basically because in the crude oil market there are buffers in the system. We went into this war with an overproduction, relatively large inventories, and we have strategic or emergency inventories across the OECD area and in China. If we do a back of the envelope sort of calculation, we talk about the G7, which is that what Financial Times mentioned. They talk about 1 to 1.1 billion barrels. On top of that, China has at least the same amount. So it's actually quite a lot of crude oil on inventories. The issue of releasing strategic inventories is, of course, you can only do it once, and if the crisis is not resolved, then you actually end up very, very exposed to further supply issues, supply cutoffs. But if we say that 15 million barrels, maybe that is a bit too much, is missing from the Middle East, the G7 countries can basically, in theory, cover 67 days. That is in theory. There is a limited release rate here. US, for example, the administration say that they can release 4.4 million barrels per day, and they can do that for 90 days. It's simply not able to release more for physical reasons into the market. But of course, if there is an announcement coming out of a release, a lot of focus will be on how much are they going to release. They're not going to release everything. They may also do it in steps. And if we get a reopening, they will of course come back. It's hard to see what the market is expecting, but if we get a like 500-600 million barrels release, it will probably be seen as a big release. 100-200 barrels will be seen as a disappointment. The International Energy Agency, in my view, has been a bit behind the curve here. I was actually surprised that they didn't take this meeting on Monday. They're having a meeting tonight in New York, so we may expect a decision late tonight. But why did it take 1 week with one of the biggest crises in energy history since the first and the second oil crisis? But it's coming now, and it takes some pressure off the market. But it is popular, as we say, it's a bit like peeing your pants. It keeps you warm now, but it may get cold later, and that is basically what is going on here. But there is a lot of oil on these storages. Importantly, there are very little products. There are some products in Europe. There's basically no products in the US, also some products in Asia. And importantly, remember, the issue is the products, not the crude oil. It's the products that we are lacking the most. And with that word, I will take it to you, Udayan, because if there's one market we're seeing this in, it is in diesel/gas oil, and then notably in jet fuel. And what you see on the screen is the crack to the left, spot price to the right. The crack is the difference for 1 barrel of product versus 1 barrel of Brent.
Morning, Arne. Morning, everyone. Yeah, I think when we were sitting here last week, Arne, we were all a bit puzzled on the move in Brent. But the products really took the lead last week. I think if you looked at gas oil futures to begin with, the gas oil cracks widened. The next day we saw jet differentials on top of the gas oil futures. So if we look at the gas oil move, the gas oil futures move, jet prices as a difference to the gas oil futures, that thing skyrocketed as well. The reasons, as you mentioned, Arne, and we discussed it last week as well, is Europe in particular, but generally most of the world gets a lot of distillate supplies from the Middle East. And if that route is choked as it is right now, plus I think Saudi's biggest refinery is also out. So it has a severe impact on distillate supplies. The US cannot make up for distillate supplies to that scale. There's Nigeria, but all of these take time. And the other element to this is freight. So from what we are hearing from our other distillate traders is to ship things out of the US, even if there was products, the freight is just so expensive, and that prices into the products as well. Having said that, the move today, the violent move that we see today, is mostly Brent driven. I think after the outages we saw in Iraq and UAE over the weekend, their production cuts, I think the Brent market has finally woken up. But in terms of the cracks, I would say the cracks moved first. This move here, cracks are fairly stable. It looks like a fairly big move in the products, but it's just because Brent has moved a lot overnight. But the situation remains, as you say, inventories are low, not just in Europe, but Europe is especially severe. And there's not enough product coming out of the Middle East. So essentially either India needs to step in, or Nigeria, the Dangote refinery in Nigeria has to step in, or someone big has to step in to make up for the supplies.
Thank you, Udayan. I think we can add on top of that, the issue is particular for Europe because we have the sanction on Russian, not only products, but also products based on Russian crude, meaning that we have become much more reliant on Middle East and the Hormuz Strait over the last 2 months, basically.
Correct. And there was some news out that the US has given India, and India's got one of the biggest refineries, and they've given them a waiver to get Russian crude. And it'll be interesting to see how much of it ends up in Europe, given the tariff situation. I would say, given the circumstances right now, Europe might turn a blind eye to observance on the rules around the tariffs.
Thank
but
you.
All of that will take some time. It cannot happen overnight or in a week, and that's the thing you're seeing right now with the disruptions.
Udayan, can you say a few words on very briefly on the option market and also sort of liquidity in distillates in general?
Options on distillates is pretty much non-existent. I think the market's dead. I mean, there was to some point, but now, I mean, when vols go this high up and markets are moving like $100, $200 on a daily basis, I don't think there's anyone willing to trade options on these things.
Okay.
But I mean,
on Brent, there is still a market.
Brent is a lot more of a liquid market, and there you do see, and it's essentially in all of this because it's such a physically related thing at the moment. It's not just a risk sentiment thing. There's actual barrels, products missing, which you see in the spreads and you see in the prompt contracts. So most of the action is happening in the prompt contracts in Brent. The back is fairly well behaved.
Thank you, Udayan. Let's move to the from the top of the barrel to the low end of the barrel. Marius, I will invite you into the to talk directly from Singapore. I know you've been up all night and took one for the team there. Can you say a bit about the bunker fuel, the fuel oil market, the HSFO and the VLSFO, and what you see on the screen? Yeah, 0.5, 3.5 for Rotterdam to the left, and the same just for Singapore on the right. And again, it's the cracks, not the flat prices. So again, the difference between 1 barrel of fuel oil relative to 1 barrel of Brent. Marius?
Good morning. Thank you, Arne. Good morning. Arne, good morning all. I will agree with Udayan in the fact that oil is actually playing catch up right now. If you ask me to assess my opinion of the market, I would probably have to divide it today in two pieces. The morning one, when you actually see crude rallying considerably, the products following. Remember, the products have been leading all this time, this rally. So the products following, the structure is getting stronger. And then the second part, which is like around 10 o'clock Denmark time or 9 o'clock UK time, if you prefer, which is like after the Singapore window where things start to drift down. Crude is losing a little bit of value. Products also, the cracks kind of losing their initial strength. Overall, they remain strong, but the general assessment is that now, up to now, products have been leading, but now oil is playing catch up. Exactly what Udayan actually pointed out earlier. Now, if we go to the bottom of the barrel, as I'm sure you are all aware, the Asian market is the one that is primarily affected with most of the trade flows from the Gulf, heading as most of the trade flows from the Gulf are heading towards Asia. As a result, you see a kind of profound strengthening of the high sulfur and the 0.5 fuel, which obviously you see in the graphs that Arne has kindly put there on a crack basis, of course, which is the relative strength of the product against the benchmark, which is crude. Typically, what happens here is when high sulfur fuel oil becomes tight, which is the case right now, with cracks rallying, of course, and structure getting stronger. By structure meaning the time spreads. The mid-sulfur blending components that go into the 0.5 pool. Remember, 0.5 is like a blending product. It doesn't come out with the distillation column straight away. Shift towards the high sulfur blending pool. What do I want to say here is that you've got the high sulfur and you've got the 0.5, and then you've got some blending components that you can blend it with high sulfur and then create and distillates and create 0.5, or you can send it towards the high sulfur blending pool, wherever the strength is more profound, in order, of course, for the refinery to make the money. So when high sulfur is getting stronger, then these blending components are leaving from the 0.5 pool and going towards the high sulfur pool. This is creating a bit of a liquidity shortage in the 0.5 pool, and then you have strong high sulfur, and then you have the effect of it like a strong 0.5. Which is the case right now. And of course, this is a case for Asia, but this is also the case for Europe. And why? Because effectively, the strength in Asia is pulling barrels from Europe towards that region, and it's creating a shortage also in Europe. So you have something like a perfect storm brewing right now, starting, of course, with Asia leading the way, and of course, Europe following suit. This is more or less the case of what's going on. I mean, Arne has put there some very interesting graphs. You've seen massive movements there, massive movements for high sulfur, massive movements for 0.5. Definitely, oil is playing catch up. The market is easing a little bit, but we are definitely stronger on a crack basis compared to where we actually closed the day on Friday. So the strength of the product continues.
Marius, one question for you. Do you think the market is prepared for a release of the strategic inventories?
I'm not quite sure what to think of that, because that also means that releasing the strategic inventories, people will probably think, oh, okay, so now there is a nuclear weapon that has been already used, and what's going to happen if we have more tightness in the market? What are they going to do? Where are they going to find the additional barrels? That means that the spare capacity might be in the form, of course, of additional volume coming in from SPR or whatever, is not going to be there anymore. So, I mean, depending on how the market will evaluate this and what they might think, I mean, it can be like a two-edged sword. It can work towards the downside, but it can also kind of support the upside, because people might think that, okay, now in a new supply shock, we're not going to be having any release because there's none. They already gave it.
Thank you.
It's difficult to assess.
Yeah, thank you, Marius. Let's see. I think it could come out today or at least tomorrow. So we'll see. Just very briefly on the LNG, the TTF. Not much to report there. Actually, the market's of course higher compared to before the war. The story is the same: 20% of LNG coming through the Strait of Hormuz. Small inventories in Europe. We have to do refilling. And one of the things I've noticed is that Putin is trying to push his agenda, saying that he could also not deliver any gas to Europe. In this situation, around 13% of European gas is coming from Russia, some through the Turk Stream, some through LNG. And to be honest, he has a point. There is still a what you call a positive netback. You get a higher price if you ship your LNG to Asia than Europe. So there is actually an economic incentive for Putin to ship, other than the political incentive to push LNG towards Asia. And I think on top of that, notice in many of the products that we talked about, the oil, it's very much the front end that has been pushed very violently higher. In gas, it is the whole 2026 that are moving higher because the refilling risk is putting pressure on prices out on the curve. And then over to you, Sean, live from Dubai. I hope you are safe. Can you say a few words from a sourcing perspective? And here we talk about bunker fuel in general.
No problem. Thanks, Arne. Yes, I think, the slide that we've got here I showed last week, and yes, we've had incidents before, and I think we probably would have thought that the situation had calmed down by now. Unfortunately, if anything, it is intensified. It's been a pretty disruptive weekend for us here. Unfortunately, some fatalities as well. So yeah, everybody is naturally on edge from a both personal and business perspective. Shipping is being hit hard. If we obviously look at the significant impact it's having, it was clear overnight. We had seen that operations at Fujairah had started to resume, albeit very, very slowly. But unfortunately, FOTT terminal at Fujairah was hit last night. All vessels that were at the berth were evacuated to the anchorage. So that has pushed back any loading significantly, and any light at the end of the tunnel in terms of seeing some product relievement back into the market. If we look at the next slide, we still obviously have a number of vessels that are stuck inside the Gulf. It's reported close to 3,000 are there. And of course, there are a significant amount of bulk vessels, containers around 130, tankers over 200, and we also have a number of cruise ships, and some of those also have passengers on board. So it's becoming actually a very critical situation, particularly for these vessels where ROB of the bunker available is running significantly low. Because what we have is the bunker barges that are operating in the Gulf cannot sail the Strait of Hormuz. There has been reports in the media of 2 bunker barges have been hit. So this is putting significant pressure on owners, on insurance, and most importantly, the safety of the crew. The market is close to running dry. There are a few limited solutions in place in the Gulf for both gas oil and VLSFO. High sulfur, there is nothing available, but if you do have anything, please do reach out to us. We are finding some limited solutions in place to ensure vessels are able to get the product they need to effectively keep the vessels running. If we look at the next slide, we also have to consider the activity and everything that we're seeing. We normally see 110 vessels sail the Strait of Hormuz. We would also see up to 40-50 bunker STSs per day happening at Fujairah anchorage. This is down to low single digits. 1 to 2 were seen last week as well. So activity here has dropped significantly. We obviously all woke up today. We are seeing bunker prices that, for us that have been in the market a long time, we have never seen. It's really going to be looking back on this as a historic day, unfortunately for some of the wrong reasons. But pricing is significant in the Gulf, especially for those that have availability. Prices are being offered at whatever suppliers wish to offer. So please, when you have demand in the Gulf especially, and you have nowhere else to go, you need to act quick, keep the quantities firm, and act decisively to make sure you secure the product. It is pretty much a first come, first serve basis. Longer term, we then have to start looking at the structural impact, of which it will be fairly severe, particularly on high sulfur and VLSFO. There will be structural changes to this market. And of course, there will be long-term repercussions on the confidence of the market. It is resilient. We have been here before, but it will take a bit of a longer time to bounce back. But yeah, open to any questions, Arne.
Thank you, Sean. Can you say just a few words on the sort of availability in the main ports, Singapore, Rotterdam, on top of what Mary said about the market pricing?
Yeah, and I think, of course, outside of the Gulf and everything we're seeing on the ground, in the air, and of course in the shipping perspective, yeah, I must point out that the general tightness we're experiencing in the Gulf, the wider impact of bunker hubs is also significant. The general markets from ARA to the Med and also out to Singapore are all experiencing a significant amount more inquiries as that from the Gulf dissipates to other areas. We are seeing strict validity, very, very short. And those orders, for example, with quantity ranges, only the minimum quantity is being looked at and being offered. It is becoming extremely tight across all ports. And we do run the risk of dry, limited availability in certain areas. The longer this conflict goes on, if we look at the Al Zour refinery in Kuwait, it is a massive exporter of VLSFO, particularly for the Gulf and Asia. They have declared force majeure. The Strait of Hormuz is de facto closed. So we're going to have to look for alternatives, as Udayan mentioned earlier, from the likes of Dangote.
Thank you, Sean. And again, you can ask questions using the Q&A button, and then use the panel to the right. We already received a few questions. I'll give this one to you, Udayan, or maybe Marius. WTI Brent spread. Any comments there? How has that done in this crisis? Maybe you can come back with that, and I'll take another question while you're just looking into to that. A question I want to ask: any indication that the EU may open up for Russian oil and gas? Do remember that the US has given this waiver, as Udayan said, for Russian oil at sea that can be shipped to India now. Could we see something similar in Europe? I don't think we are there yet, but I do think there's probably a lot of pressure from what we call industry groups in various places in Europe, probably also from Hungary and Slovakia. But I don't think that EU will give in here. First of all, we will at least see a release of the reserves in Europe before that will come up to discussion that we should allow more Russian oil and gas in Europe. And there's a question. We hear that physical suppliers suddenly face financial challenges as a result of the spike in prices. What are the dynamics and risk here? I don't know if Sean, if there's something you would say anything on.
Yeah, I think look at the pricing. It's unheard of. It is going to have a significant strain on credit and the cash flow. Obviously, suppliers now are having to go into the market. They're having to buy cargoes at prices that have doubled, tripled, quadrupled in some cases. Short term, we are certainly going to see constraints. We are going to see payment terms from suppliers reduced from the typical 21 to 30 days to CIA to 7 days.
Thank you, Sean. Any comments, guys, on the WTI Brent?
Just quickly, I think
sorry.
Maybe I'll go ahead. Quickly spend 2 minutes, and then Marius, you can come in. But as I mentioned, Arne, this is a very physically driven crisis, and where you would expect to see the biggest impact is the spreads. Of course, we look at Brent futures prices, we look at gas oil prices, but it's fairly clear that the spreads have led the way, which you would expect in a physical crisis like this. So the spreads have been extremely violent in the front. If you look at the front spreads on gas oil, I mean, things which are typically like $1 now are close to $10. So it's extremely violent. I don't know if Marius would agree with me on that.
Yes, absolutely. Yeah. Absolutely. TI is a more like a local market, I would actually say. So it's highly dependent from the US production and the cashing inventories. Having said that, since the beginning of the hostilities, Brent has been TI Brent has been drifting lower and lower on a daily basis. However, it seems that the last couple of days like Thursday and Friday, has been playing some very, very serious catch-up, which kind of brought it to levels before the hostilities. You would expect that Brent would be more affected on this case. However, WTI did play catch up towards the end of the week. It seems that today again is kind of losing ground. It seems that the Brent is definitely leading this rally. But I wouldn't be bullish WTI against Brent with all that is going on in the Middle East. I would probably say that the odds are that the Brent is going to outperform WTI in terms of strength.
Thank you, Marius. There's a question from Jesper on the impact on the economy, demand/freight rates. Of course, this is not the 70s. The global economy is less dependent on oil and gas compared to back then. But we're also in a situation where we have a real lack of products and a real lack of crude oil. Then we need to see some what we call demand destruction. And the question is, of course, what is the level for that? I'm not sure we have reached that level yet where we will see real demand destruction. That actually points towards higher prices. But of course, overall, the global economy is less dependent on oil. But the rapid rise is a shock for the global consumer because it happens so fast. So you take a lot of purchasing power away from especially U.S. consumer here in March. And there's a question for you, Sean. I think that will be the last question. Are you hearing any supply contracts getting cancelled from suppliers in Singapore, Colombo, or any other country, or also at any refinery cuts for bunker fuel? I think at least the first one for you, Sean, if you have any comments there.
Yeah, I think in general, we're obviously hearing a lot of force majeure being declared by players and physicals in the Middle East. This is not the case in Singapore, but the Singapore suppliers, we do understand, are looking at the minimum commitments only, but obviously it will be a case by case per supplier. So it's important here, communication more than ever, have those discussions, see what capabilities the suppliers have, because again, the longer this goes on, the more the struggle will be to resupply and replenish the products that they need on their barges to supply. And it will have a general wider impact in other ports as well, such as Colombo.
Thank you, Sean. Thank you, Udayan. Thank you, Marius, for taking part today. I think that's all we have time for today. Time is running. We will see if we can maybe, or please feel free to reach out to us. Those who we didn't have time to do the questions, but we have to say thank you for today. I think we're already 13 minutes above our time. So that's all for today. Expect another volatile week, and especially you, Sean, in the Middle East. Please stay safe. Thank you. Have a good day.